All right, I think we have everybody coming in now. Give them just a couple of minutes. We have quite a few people that are logging on in rapid succession, so we will let them log on. We have started Facebook Live at this point, so I want to go ahead and just welcome everybody to this series that we're calling Relevant Conversations in the Current Crisis. And today's topic, we're going to be talking about the current market conditions that exist in this environment in which we live, especially in light of the coronavirus. And this is a huge topic, and we recognize that just trying to give this a 30-minute time block is not going to be anywhere near sufficient to be able to cover the depth of this particular topic. So we're going to do our best to cover as much as we can in the time slot that we have given to this topic. If we go over a little bit, that's fine too. We hope you kind of hang in there with us. Just want to check again real quickly on our attendees. They're kind of loading up. I just want to make sure everybody's participating and no one's having to wait on me. But just some quick reminders, if you're logging on to Zoom, and if the meeting happens to be full, then you can kind of catch us over in Facebook Live. There's just a little bit of a delay between the live broadcast and Facebook Live of about 20 seconds. And if you're in the Zoom conference with us, then you have down at the bottom of your screen a little section for Q&A. And we would like for you to kind of take advantage of that. If we can get to your question while we're online, that'd be great. Fantastic. We'll try to do that and monitor those questions as we move forward in the broadcast. If we can't get to those questions, we still want them because they're extremely important to the topic. We can filter through those questions and see what the most frequently asked questions are. And that way we know if we need to kind of circle back around and have another session that gets a little bit more specific. And if nothing else, we can kind of share that general expectation that the audience has so that we can maybe schedule some future sessions. But I want to kind of get with it as quickly as can to deal with the topic that's at hand. And I want to introduce everyone to the team that is with us as panelists for this session from WealthSouth here in Lexington, Kentucky. It's a financial services firm that provides families and businesses with financial planning, with trust services, investments, commercial banking, and retirement plan services. And our guest today out of the Lexington office, as you can kind of see to my to the screen left is Mr. Clint Long. He is the institutional investment consultant with WealthSouth. To the bottom of Clint is James Faraday, who's the chief investment officer. And then last but not least, we have Tim Yessen, who is the wealth management advisor there. And they've got a really good, strong team there. And we're excited to be able to have them on this broadcast. And guys, you need to pump us up. And we've got about the next 28 minutes and 30 seconds to do so. So I'm going to kind of turn it over to you.
Great. Well, I'm off to an awful start because my battery saver just came on. I forgot to plug my computer in. So as soon as I get done opening this up, you're going to see me disappear for a second.
Completely fine.
I did want to address everybody just to set expectations as we get going. The answers you hear from us today are going to be with regard to generally balanced portfolios. So we're assuming some sort of 60% stock, 40% bond, maybe 50-50 asset mix. Obviously, that's not going to encompass everybody who's joined us here today. So as you assess some of the information that you're given, be sure to put it through the filter of your own situation, what your cash flow needs, maybe an increased or decreased risk profile. And then, as Mark indicated, we're going to keep it fairly general with the answers. If there is a demand for a more technical call, we'll certainly make sure that gets scheduled somewhere down the road. But what we wanted to do is just set what have we been through over the course of the last month and a half, and obviously it's been pretty historic. If you look at every general domestic index out there, we've seen anywhere from a 30 to 35% loss from the top of the market to the very bottom. Some of the good news, if you've been monitoring things today, we've been able to claw some of those losses back. So if you go from the top to where we stand as of about lunchtime today, I was just looking at the S&P, we're no longer down 35% from the top, we're down about 22.25%. So obviously nobody wants 22.25, but when you put it against the down 35, that's certainly going to be a little bit more palatable. So that's where we stand today in the investment arena, particularly on the equity side. we certainly want to assess your questions, but we thought we'd kick off today with a question that we're hearing most often from clients or investors that we're talking to. And it's some version of, what do we do now? Am I too late to make a move? And so I'm gonna turn it to James, and I'm gonna pose this question to him and let him get us started. And you may notice James isn't in an office; he's in our protected WealthSouth bunker. He's our most valuable asset, so we've got him set aside.
Yes. Yeah.
But James, what should investors do at this point with portfolios? What are moves that they can make to be proactive?
Absolutely. Thanks, Clint. Thanks, Mark, for the introduction. Yes, so full disclosures from my side. I'm in my bunker at my house. There may be children walking in and out. There may be dogs barking in the background. I do not know what might happen today, but
It's the world we live in, my friend. That's okay.
Bear with me as we go through. So as Clint said, we're in a bear market. So all that means is 20% drop from the peak to the bottom. We've gone below that. We've clawed a little bit back, but one of the reasons we recommend to clients not to make any big moves during these type of market corrections is because of the volatility. And we see huge amounts of volatility over the last 3 to 4 weeks. In fact, if you look at historic averages, March was the most volatile month on record that we've ever seen since they've been tracking those volatility measures. So number one, this is not the best time, number one, to be cashing out. A lot of clients are saying, should I cash out right now? Should I protect myself? No, we would say not a great time to cash out, and really not a great time to reduce your risk exposure. We would argue, in fact, that this is during times of fear and panic and market corrections like this is often a time to re-risk potentially your portfolio too. So we're doing a lot of rebalancing for clients right now. And all that means is, say, for example, your risk profile was set up by your portfolio manager or advisor, or if you did it yourself, say you had a 60-40, like Clint mentioned at the beginning of the conversation. Maybe that equity position now is down to 55% equity. So this is a great time to be kind of just incrementally adding back up to that 60% level out there. If you're in, say, for example, I know a lot of us are in retirement plan funds with target date funds or asset allocation funds. Most often that rebalancing is done for you. So that's a great, that's a great thing for you. But check on that. You want to check each investment out there. Certainly if you have an advisor or a portfolio manager, they're going to be doing that for you out there.
Yeah.
Absolutely. And I think James really points to the real critical piece, and it's most critical during these times, is to stay true to your discipline. If you have a discipline, stay true to it, particularly now. This is when the discipline does pay off.
Right. Well, and that's a huge issue because we are creatures of habit, number one, and some of the same parts of our brain that come into our mortal preservation kind of kick in when we see the market behaving like it's behaving right now. And, for a long time, I followed a little bit more for like the behavioral and psychological side of investing in the market. And it's hands down proven over time again that our emotions kind of get the best of us when we're looking at something like this. And therefore can kind of lead to some really decisions that we otherwise wouldn't make as far as, as the market's concerned. I mean, obviously you guys can probably speak to that just based on the volume of calls that you're getting and the angst and the concern that most people raise.
No question. Rebalancing is one of those fundamentals that you should always be doing, even in an extreme bull market like we had in the run up to this. It does force you to take risk off the table. And certainly people that have done that and maintain that discipline are going to benefit from that approach when we have a pullback like this. And conversely, like James was saying, adding some risk, keeping that discipline in place where you're rebalancing upward in this case, certainly pays off in the long run. No question.
Well, speaking of the market run, so we kind of hit a peak there in the middle of March. Well, we kind of hit a peak in the middle of February, and then we have certainly been on the downslide ever since then. So, what are you seeing kind of on the risk side where people who've been riding the high for a long time and now you see such a downside to the market and you're trying to measure risk tolerance? What are you seeing? That as we ride the mountain up to the top, we probably think we're a whole lot more risk averse, or we think we're actually more risk tolerable than what we probably really are. Is that what you're seeing? That clients
exactly
at one
right.
time kind of thought, well, great, I feel like I'm pretty set on the risk side until they see such a slide. So how do you come in to try to calm that water down for them?
Yeah, no, absolutely. And the context is we've been in a historic 10-year bull market, right? So a lot of investors, if you haven't been invested prior to 0809, you've really had kind of a smooth ride for the last 10 years. Last year, we had a huge up year for the equity markets. And it's times like these that really test whether, okay, are you in the right risk posture? And hopefully your advisor got you in that right risk posture before the correction happened. And what we try to do with our clients is really talk to them beforehand. This is the potential drawdown that you might experience in a 60-40 portfolio. Can you withstand that? And that's a tough conversation to have with clients in that, oh yeah, when you're just sitting around a table talking about it, it's easy to say, sure, I can handle that drawdown. But when you're actually going through it, it can be a different scenario.
And I think it's as simple, Mark, as knowing that if we were never going to see these pullbacks, we'd all stay 100% invested in equity all the time.
Absolutely.
That's the reason that these portfolios are built the way they are, built with this balanced posture, so that when that run stops, there is some protection as the bottom starts to fall out of the market, that you're somewhat insulated from that.
Right. Yeah. So just kind of help me with this a little bit, because James, you kind of mentioned earlier that we've been on a 10-year run.
Yeah.
That's a pretty long bull market. So how long would we have typically expected a bull market to run, just when you kind of go back and you measure things historically?
Right. It typically it's about half that time.
Okay.
So usually
we've been doing this for a long time, one way or the other.
And I think that's why, for the last probably 3 years, I've had clients ask me, is this run over? Is this run over? What's going to tip us over the edge? And certainly nobody saw COVID-19 coming. And it definitely was one of those black swan events, is how the investment community describes it. Out of the blue, came out there, and valuations were higher, right? If you looked at valuations in the marketplace, they were at the higher end of the range. So what we've been doing for clients over the last 2-3 years is taking risk off the table. So if you had a 60-40 and your equities are rising up to 63, 64, 65, been trying to take that down a little closer to their neutral positions. So that's one way we've dealt with the risk that's been kind of building over the last 2-3 years.
Okay. Look like somebody else was about to say something before I chime back in. I want you guys, your expertise is coming to the table. I might have a lot of questions, but I'm not sure it's going to be the expert questions. So if it is, we've been on this 10-year run. You mentioned this as being a correction. So I'm curious, what's the difference between a correction and a recession or a bear market?
Sure. So I'll take this one, and Tim, you can chime in too. So a correction or a bear market is defined as a 20% drop from the top to the bottom. So clearly we're in a bear market right now. A recession is more to do with the economic growth of our economy. Okay. So if we have the textbook definition is 2 back-to-back negative GDP quarters for the economy. So right now, our estimates and the research that we've been looking at show that we probably will have a negative first quarter decline in GDP. The second quarter is going to be, we've seen estimates ranging anywhere from -15 to -30% on the low side. And of course, we just don't know at this point, right, in terms of where things are going to go because there's no visibility. So everything right now is coming back to the duration of how long are we all going to be in our offices at home, like I am today,
right?
And when do we go back to work, so to speak? So that's why a lot of companies out there right now, they're not giving any guidance for the future because they just don't know where earnings are going to go.
Okay, so that brings up another question then. So if we're in maybe the beginnings of the recession, so we may or may not know whether we're in one technically or not, because we haven't had time to measure that. We know at least from President Trump, we're going to be ending April with pretty much everybody's going to stay at home. So we kind of have to see where this goes with May.
Yeah.
If it is a recession, I hear, you listen to people, they're so negative, number one, but number two, you keep hearing this being referred to as unprecedented, and nobody's really defining what piece is unprecedented. It's not unprecedented to have a correction. It's not unprecedented to have a bear market. It's not unprecedented to have a recession. So what?
It's not
what
unprecedented to have a pandemic.
Right. Well, even that. Now, maybe the scale of the pandemic may be unprecedented. So, in other terms that we might look at a recessionary period, I guess the question that I have that kind of comes to the table is there's different things that normally move us into that recession. Because am I wrong to say that recessions are generally meant to correct an imbalance that already exists in the market?
Yes, I think you are. And I think what a lot of economists are looking at is whether this is an event-driven recession or a structural recession. And I think when you look at most recessions that we've been in history, they've been structural recessions, either an overinvestment in one form or another in some particular market. In this case, we got an event that triggered this whole thing, and we had a complete shutdown of the U.S. economy and the world economy, for that matter. And so, when they're looking at this, the economists are trying to predict whether this is going to last. Structurally, let me back up a bit, but structural recessions tend to last a bit longer because they have to work through the malinvestment that happened during that period of time. Go ahead. Sorry.
Well, can you give us an example of that, though?
A structural recession was very much like 2008, when we had a banking segment that was overinvesting in real estate. The real estate quit increasing in value. The banks had to work through, with their capital resources, with their reserves, work through that period of time of overinvestment in real estate. It took them a long time to get their capital back in a situation where they'd lend again. In this case, we've got an event that happened. The banks are much, much stronger, and banks are like the oil in an engine. They really help capital formation, and they help businesses grow, putting in a new production line, for example. The banks are not impaired right now. Right now, it looks like their capital resources are much higher, 2 to 3 percentage points higher than they were in 2008, prior to 2008, and certainly after 2008, that recession then. So they look like they're equipped to weather this much better. So economists are looking at this. Can we get through this period of time where we are shut down, but do we rebound quickly? Does the consumer rebound? Does the consumer spring back after maybe the second quarter of this year and help power the economy back? Because we don't have an impaired banking system. That's real critical for recessions to end. And when you look, I know James has got some data on relative lengths of structural recessions where we have that malinvestment like 2008 versus event-driven recessions like maybe we had in 1990 when we had the first Gulf War.
Right.
Much more of a shallow recession and a much quicker recovery as well.
Well, I think that would be important to be able to distinguish for our audience, because like you said, there's two different types, and one is more systemic, or you're calling structural, which means there's a flaw in the system that needs to be corrected. So whether that's the tech bubble, whether that's the banking industry, and of course I think it's kind of interesting now, since the banking industry kind of led the last recession or last period, they've learned some lessons that have actually well positioned them. Would you agree to this recession?
No question.
If we're entering into a recession. So this is not all for naught. Recessions have their purpose, and they have a way of bringing out the better at the very end of it. And so it shouldn't be something that we necessarily want to run and hide from as much as we welcome, to the extent that we just can't control otherwise some elements of it. And then we see that there's some things that will happen on the other end that well position us better than what we were before we went into it. So something's going to be corrected, except this one's obviously more event driven than anything else. So James, that would be really interesting to kind of see what that difference is and what historically that's panned out to be, because usually you have a pullback, and at some point in time, what goes down has to come up.
Exactly. It becomes mathematical at a certain point.
Right.
I do have something I could share, and I will attempt to share my screen just to give you all a visual of this, because I know it's difficult when we're talking through this, just when you're hearing it. But what does it look like? Because this is a question that I've got quite a bit from clients here
I
recently.
would
So
imagine. Yeah.
I'm gonna try to bring this up on the screen, just kind of walk us through it, and we'll go from there. Let me see what I can do there. Okay.
Yeah, and keep in mind too, as James is putting this up, the market is looking 6 months in advance. So what they're pricing today in the market, the price of equities is really looking 6 months from now. So what are the markets going to be 6 months from now? They're not looking today at today's data, although today's data can affect it. Primarily, they're looking at 6 months in advance.
Is that driven more by the institutional investor versus the average day at home personal investor? So it's really the institutional guys that are kind of projecting down the 6 months and you kind of determining the price. Is that true?
I think it's a combination of all.
Okay.
I would say it's really institutional, retail. It's the market is trying to price, like Tim said, 6 months in advance. So we think a lot of the bad economic data is going to bottom well after the markets have actually bottomed. So we anticipate unemployment probably 2-3 months from now to be really, we're going to see some really bad numbers coming out. We're going to see some really bad GDP numbers come out as well. So,
okay, well, take us through this graph you have pulled up. I think it's intriguing.
So everybody, can you see that, Mark?
Yes. Perfect.
Okay, great. So like we talked about, three major types of bear markets out there and the causes of those. So we talked about the structural, so that's really like 08, 09 scenario. Cyclical bear markets, these are typically, as the name suggests, they are part of a normal market cycle, usually brought on by the Fed increasing rates too quickly or too far. And then the one that we think we're in today is this event-driven, and of course COVID-19. And then you might add on another layer over that with the energy crisis that's going on too. That's just added on some additional risk out there. So the average peak to trough, so from the top of the market to the bottom, typically takes about 8 months. So that's that 8-month number right there. To recover back to the top is about 13 months. Now this has been one of the quickest bear markets, I hate to say, ever, but it has been one of the quickest ever again. So we've gone from the top, I don't know, we'll look back in terms of where the bottom is, but
right.
We've gone down over 30% within 3 weeks. And most of that was within 1 week. So it was just a very dramatic and quick event-driven bear market that we've gone into. If you look at all three together, the averages here, 23 months average for all of them combined, and 49 months to recover for all of them. But we definitely think we're in this space down here, the event-driven type bear market.
Now, James, for those attending though, talk a little bit about some of the drivers that could take us from event-driven into structural, just given
Sure.
where markets are.
Well, and I think part of that has come out of this energy crisis that's layered over the COVID-19. So for those of you who've been following, the Russians and the Saudis have been pumping out more oil than they typically pump out, and it's caused a huge drop in the price of oil. Great at the gas pumps, right? But not good for energy companies out there. So one of the things we're watching is, how much could that overflow to the financial sector in terms of defaults? We're not seeing that yet. We do think you're going to have energy companies that do end up going bankrupt through this, unless we just see a huge change in the price of oil here over the next few weeks. But we do think that's part of it. But we still think the banks are well capitalized to handle that type of scenario as well. But that's what we would really be looking at if that was to move over to the structural type of bear market scenario. Tim, did you have anything to add there?
No, I think there was a period of time in the past 8 years where we had a little bit of a washout in energy markets, particularly in natural gas, where the price fell, and we had a lot of companies that the wells were taken over or repositioned by other companies, and I think it was actually a good thing to prepare them for what they're experiencing right now, which is sub $30 a barrel oil. It'll be interesting to see, because that is one of the unknowns. And like James said, if we do get a more protracted period of staying at home, of maybe the oil impairment that we've got, then that can bleed into the structural side of things, where banks' capital gets eroded. They're more hesitant to lend when the market does turn a bit. So right now, though, most of the economists are they're looking really for a recovery the fourth quarter of this year. I've seen a lot of data out there so far that expect a recovery certainly in the first quarter of 2021. The predictions are fairly uniform out there from what I've seen. James, I don't know if you've seen different things, but because I know we share a lot of information together, but it does seem, if there is a consensus among economists, certainly financial economists, they are looking for a relatively strong, as things are today, recovery by the first quarter of 2021.
Correct. Yeah, there's a lot of different research and data out there. I've seen positive fourth quarter GDP estimates from some firms out there, but definitely the consensus is, like Tim said, 2021.
Yeah.
And,
well, let me ask you. Well, go ahead.
Mark.
Finish your thought.
Oh, I was just going to say, the other question, how long do bear markets typically last? But then the other question is, what's the average drawdown of a event-driven bear market? And that's to the right of this page here. If you can see the hand, on average, event-driven recessions go down about -27. So we've already gone down more than that. Now we've recovered some in the last week or so. And then the next 12 months, the returns on average have averaged out around 30%. So as you would expect, you kind of see that rebound over time.
And again, James, with the drawdowns, you're talking about the negative return in the market and the darker
correct
bar. Correct. Gotcha.
And those, I mean, that tends to play into what we have historically seen as being the averages. 33% is kind of some of the numbers that I've seen as to how long, the bear market, up to even 40% drawdown on a pretty fast. I mean, that's going to give anybody some heartburn when they see those kind of things.
Yeah.
I mean, that's a steep slide, and it's just hard to imagine ourselves recovering from that. But historically, we have, and historically, it seems like the data all points to the fact that we tend to get into a stronger market on the other end of it.
Yeah, there's an economist that I work with or not work with, but know pretty well, and he has a really good quote. He said, "Tim, I used to think that our economic system was a delicate flower that had to be nurtured and protected and watered and fertilized." He said, "But no," he said, "now that I'm older, I recognize that our economic system's like a weed. It'll grow through cracks in the pavement if need be. People will find a way." And I think you've seen the innovation. I know, Mark, in some of your upcoming conversations, you're going to talk about innovation and some of the companies that have pivoted that their normal business plan, this opportunity or this event has made them pivot into something that they hadn't even considered yet. Innovation is going to happen. You've got to recognize that businesses are always out there looking for a way to make things happen. Whether it's a restaurant down the street that figures out a way to deliver food better or have curbside service, they're finding ways to adapt, and they will find ways around this, even as bad as things seem right now. They're going to find ways to innovate.
And so I think greater efficiencies are built out of times like this. I mean, look at the medium we're using to conduct this meeting today.
Right.
And we wouldn't have been using this a month ago. So, and I'm of the opinion that this is going to change the way business meetings are conducted forever.
I would think there's a lot of things.
Particularly the long traveler. So that's just another example of how innovation is just going to change the way we interact, change the efficiency within a business, and ultimately change the bottom line.
Yeah. Well, it's unfortunate because you normally can't have one without another, as far as just so to every one side of the coin, there's another side of the coin. And understandably, some businesses will vanish and dry up and go away.
Absolutely.
Or else being extremely hampered if they haven't really attempted to kind of reinvent themselves or figure out another way to do business. So that's inevitable. And as much as we hate to see that, it doesn't cloud the entire picture. And we have to see the flip side of this is to where everybody, necessity is the mother of all invention. And so we're going to see that tide come back. I mean, we saw it in different other periods of time, probably no more so than what we saw during World War II. I mean, the innovation that came during and after World War II is probably the only reason why we even have the innovation that we're looking at today, because it really was the driver to kind of start that. So I think we'll see ourselves come out on the other side. The only difference this seems to be, outside of all the other periods of time in which we can kind of look for this pullback, is I heard someone use this statement, and I kind of had to stop and think about it for a minute. They said this is more of an engineered recession. And I thought, man, what do you mean engineered? Almost as if it was done on purpose. But I think what they meant by that is an engineered recession in this case versus all other time when they either event-driven or systemic. There's not a systemic issue here, and it is event-driven. But layered on top of that is you got government intervention, who basically has had to as a means of preservation, really kind of pull everything back. And so this is something that government done. Now the government's also stepped in and tried to move things forward. So the stimulus package per se that's come forward that we just released, that's going to matter. We got money that's going to get into the hands of individuals. We have monies that are being infused in the hands, put into the hands of small businesses. Your big businesses, they have certain tax credits that are made available to them. Is it too little? I don't know. Is it too much? I don't think so. If the government's going to pull back, they also have to be the one to push forward, in my estimation. And we'll see how that money comes into play. I know there's some issues with this initial round of funding that's being pushed out by the SBA and the federal government, and banks are clamoring, absolutely stepping all over themselves to try to get to this. And it's been very difficult because people don't understand the clear definitions on some things. And we'll talk more about that on Thursday. And there's some unintended language, I think, that's in some of this stimulus package. But the banks aren't necessarily the one. I mean, even though they're lending the money, the federal government's on the hook because they're 100% guaranteeing these loans. So I think that's an offshoot of this topic, because when we talk about the capitalization of banks, yes, there's a temporary period of time to where the government stimulus may impact that a little bit. But I think long term, since these are relatively short notes, not very long, it still gives the banks time to maneuver and to consider their position and to do what they can as far as, unless it is, like you said earlier, Tim, they decide to have that, they have that uncertainty where they're less willing to lend. But I haven't seen that yet.
No, I don't think that, there's actually a data series out there on the credit posture of banks, and that does not look like it's changed much. Probably too early to tell because the survey's done quarterly, I believe, and I haven't seen anything that changed that yet. So
help me understand some of the good news you've seen on the horizon, in addition to the fact that the banks have been capitalized. So there's other economies that are having to go through the same thing. That's the one interesting thing about the world being flat right now, is we kind of see other economies go through the same thing. What are you seeing there that might give us some glimmer of hope?
Well, we've seen
Benny, maybe
very recently we've had some better reports coming out of Europe. So, Italy's been the hardest hit in the European nations. We did see a slowdown, it looks like, of new coronavirus cases coming out of Italy, so that was good. I think there was some good news out of Spain too. Even New York had a slowdown, it looked like, over the weekend. So those are just some good data points out there.
Well, James, was it Germany that was starting to make plans for reopening on some level?
Correct. So you've got a country like Germany looking to how do we move back into getting a business back up to 100% strength. Look at China. The data that's coming out of China, it's sometimes difficult to analyze, but it looks like they're at about 70 to 80% now in terms of utilization and capacity of their manufacturing. Their target, I think, is to be at 100% over the next couple of weeks. Now, I think you're going to have some businesses that are going to take, as you would expect, a lot longer to get back online, like the airlines, like the hotel, leisure and travel industry.
Well, and the other thing about that is we are in a more interconnected world than we probably ever existed. So as far as supply chains are concerned, one market depending on another, it seems like, we've all got to, you got some that are going to be pulling in that direction, and they may be on the forefront of pulling in that direction because we're going to be laggards in this situation to some degree because we were late to respond. but we're also a very dominant factor in there. And as we, all pull forward, that should ease the pain a little bit as I see it.
No question.
But let's bring this home just a little bit more. Okay. Because we're talking in a very high scale. So one of the things that, we've been looking at as a firm because of some of the tax legislation that's come out, let's kind of bring this back a little bit to, you've got the person who, number one, has to make a decision. Do I pull on my RMD even though that my RMD has been suspended? I don't have to do that for 2020.
Right.
Or you're looking at those clients who they don't have a choice. They're in a down market and they've got to pull on that required minimum distribution. So, help us understand, okay, how do we evaluate the needs and kind of meet those? Now, I know as far as investments are concerned, the dollar cost averaging needs to go on. Some of the things that we talked about earlier, to where you're looking, for those companies that are pretty high quality, that are kind of dislocated from what's really going on in the world, because not all companies are responding the same to this economic downturn. You've got some that continue to show strength despite. So let's bring it home as we kind of wrap this up and think about, how we evaluate and help somebody on the home front kind of look at this from the standpoint of,
I think that's a good question, because if you are in a cash crunch, if you do need to draw funds out of your investments right now, you got to really caveat this. Each person's circumstances are individual to them, and so you'll see a lot of stuff out there in finance, personal finance particularly. There are these bromides out there that say, "Oh, you should always do," and fill in the blank from that. It's real critical that you look at your individual circumstances, the tax consequences of anything you do right now, particularly with the new tax laws that have just come into place. And that's where you have to work with your accountant, like with Mark in this case, to figure out what the best approach is, because the tax is certainly a critical thing. If you have resources outside your 401k or your IRAs, do I go there first? Do I go to the IRA? I hate to be wishy-washy about it, but there's really no blanket statement you can make without looking at your individual circumstances, because those make such a big difference in how this plays out over a lifetime.
But I do think it's critical in this situation that everybody on this call and people we're not touching with this call, that you be proactive in reaching out to your tax advisor or maybe your discretionary investment manager, whoever that trusted advisor is to you, to have the conversation about what are the next steps. What do I, in your scenario, Mark, I still think I need to take my RMD even though I don't have to. Where should I take it from? And if I don't have to take my RMD, make that proactive call to say, hey, I don't want to take it. Right. Don't just assume the best decision is being made on your behalf. Reach out and help assure that best decision does get made.
Yeah. Well, the suspension of the RMD, I see it as the government's way of, for those who don't have to live on it, they have other sources of cash, and that really kind of gives them some time to recover in the market between now and the end of the year, so that their portfolio balances come back up. Plus, you had such high valuations going into this year in December, which determines the RMD, as we talked about before, that you're going into 2020 with, that some of those, because of the depressed values, just don't make sense anymore right now. So it's interesting to see. I think there might be some more things that kind of come up on that landscape, but we'll see. There's going to be a lot of things, I think, that shake out. I know we had an initial round of trying to really nail this in and to get some cash back into the hand of the taxpayer and to relax what have otherwise been some very stringent rules. We may kind of get, the next 2 or 3 weeks and 4 weeks into this, and we realize we got to relax a little bit more, so that it'll be, pretty interesting. But before we kind of really wrap up, I know we've talked about the equity markets, but I don't know that we've mentioned anything about the bond markets, because when you're talking about the 60-40 split, which you kind of traditionally see, this is very generic information, not generic. That's a bad word. So let me retract that. This is very general. Thank you. Yeah. There's nothing generic about it. We hope we're providing extreme value to everybody that's listening to this call. So we'll strike that word from the recording. But yes, general information. But I don't know that have we talked about the bond side and what you're seeing there too? Because usually equities and bonds have acted, inversely
offset each other often.
However, we saw in 2008 they responded the same way, right?
Right.
So what are we seeing now?
So initially, when we first started seeing the correction happen, bonds were holding up pretty well. And then I think it was either week 2 or week 3 where we just saw all asset classes sell off. So equities were selling off, treasuries, agencies, mortgage-backed securities, real estate was selling off, everything across the board, oil was selling off. Didn't matter what asset you owned. And what was happening was businesses and individuals were needing liquidity for a variety of reasons. So they were selling anything they could. And in the bond markets, you added on a layer on top of that was that you had a lot of these bond traders doing what I'm doing, sitting at home trying to trade these bonds, and they didn't have the same system set up and so forth to be able to quickly manage those facilities. Now, what we've seen is in the bond markets, the Fed stepped in very quickly and has supported those credit facilities. And I think part of the rebound we've seen in equities is because the liquidity has flown, has come back into those bond markets. So they've supported it in several different ways with different facilities. They took out I think they took out the handbook from 0809 and said, okay, let's get this in place right now.
Yeah,
and
we've seen this before.
Worked. Right. Yeah.
Well, that's good.
There's a question that someone posted earlier in the conference, and I think it's a really good discussion point because some people are sitting on cash right now. What do you do, yes. James? Take me through what you do if you're sitting on a substantial or even a small portion of cash right now. Maybe take us through what you're doing right now if you had an account that maybe transferred here, for example, and was a cash.
Well, first of all, that's great news that you have that cash.
Yeah,
but no, you're up
20% really when you look at it in relative terms, which is a big benefit. Absolutely.
That's right. And we've started to have clients, talk about fresh cash, bring in new cash. Should we be starting to invest now? And no one can tell you where the bottom is on this. So what we're doing is it's a slow process of dollar cost averaging in new cash, 1 to 2% at a time. So you're not taking a huge risk, because we do think we'll still have a lot of volatility between, now and when we learn kind of when the end of this crisis is going to occur. Nobody knows, of course. So it's got to be a deliberate, slow approach. You don't want to just dump in all your cash tomorrow into the stock market.
Yep.
Yeah. So if you're taking, let's just say that you had 10% of a portfolio of someone's, when you're looking at this, I think, again, individual circumstances vary, but let's just say you had 10% of a client's total liquid or investable net worth, 10% in cash. You're taking what percentage per quarter right now, bleeding it in? Are you looking for opportunities? Are you looking for particular companies? What are you looking at? And maybe more specifically on some of those things.
We would look on the big down days. We would look to put in, anywhere from about 1 to 1.5% into the market. And there's different parts of the markets that we think are offering some great value right now. If you look at the financial sector being one, great valuations right now. The healthcare sector has some good valuations. So those are two sectors that we've looked at primarily. Even on the bond side of the equation right now, there is some value on the corporate bond side. So we have been looking there as well to add to positions to where, 2 months ago, the prices were just sky high. So some of those prices have come back down now.
Yeah, gotcha.
Well, guys, I appreciate it. This is, to me, it's been a very encouraging call, certainly informational. I think we've had a really good response to some of those that are attending. And this is a recorded call, so we will make this video available to anybody that's interested in it. I think it's been a great conversation. I think at the very, very end of it all is, we might have some rough days ahead. There's no doubt. I don't think we need to walk away from this call thinking that tomorrow starts all of a sudden we just start this uptick. I don't think that is necessarily what we can expect. But I don't know that any of us know what to expect. So what we do is we have to prepare ourselves for the downside, pretty much, and be willing to look for the opportunities to take the upside. But the point is talk and have a conversation with those who are here to help you. If you're a financial advisor, your CPA, whomever, don't just sit there. We have to have a dialogue. We cannot help if we don't have communication. And that's huge right now. We've got to we got to be having those proactive and active dialogues in order to, number one, just have a sense of certainty again in an extremely uncertain world. At least we have some clarity, I should say. We know what direction we need to head. And sometimes that's just peace of mind enough that help us to weather some even worse days that may be ahead. So I appreciate and love the context that you guys have provided in this call. Is there any other point that we missed we might want to touch on real quickly, or you feel like we've kind of wrapped that bag up pretty well?
Mark, I think you actually hit on one there. I was reading an article a couple of weeks ago about, it was kind of centered around psychology, and it said the hardest thing for the human brain to deal with is uncertainty. It's what we as humans are least equipped to deal with, and then translate that uncertainty over to the market, and now it's our uncertainty plus our nest egg, which makes us all the more uneasy. So I think you nailed it. If you're concerned, reach out, have a discussion with whoever you've charged in being your advisor, and work through it with them until you're no longer feeling the anxiety.
There is no doubt about the role psychology, at least behavioral psychology, plays in times like this. And speaking of which, later on in this series, we will have some psychologists kind of in the mix of the discussion, and we'll try to we'll do our best to try to hit on all cylinders with them and topics with them as well. So it's going to be an interesting series. I really appreciate you guys choosing to participate. It's been fun. I appreciate it. I enjoy the dialogue that we kind of have at all other times. It's a great dynamic, so I appreciate it. Just real quickly, all of us have had to take a step back in this whole thing, and the one thing that we really have been wanting to do with this series is just make it really personal. And obviously there's some takeaways, there's some lessons, and if you're willing to share those, and what's been your kind of biggest takeaway in the last few weeks, as we've all certainly had to deal with something we haven't had to deal with before in our lifetimes. Some of the biggest lessons.
Yeah, I'll take that one, Mark. One, I found a decent use for my son's gaming headphones. They seemed like a wasted purchase, and now we finally put them to good use. But for me, it's really been, technology and screens. I've preached to my kids: get off your phone, get away from technology, get outside. And what I've taken away from this is technology can enhance so much of what we're doing. It's become so vital for us to stay connected, whether it's kids doing classes through this, churches holding services online, even something as silly as, me and my kids videotaping a trick shot on our iPhones that we did around the house this weekend. It's just become a vital part of our fabric. And when it's used the right way, it enhances our lives. Yep.
Good book though, by the way. You know how I recommend books all the time.
Digital Minimalism. I'm about 5 behind on book.
You're about 5 behind? Well, Digital Minimalism by Cal Newport. Excellent book. If you want to know a little bit more about it.
Everybody listening, take that down.
Yes, because Mark asks for book reports
later. Yes.
Right.
All right. Tim or James, what do you guys have?
I'd echo what Clint says. I think it's a time when we're never going to forget this. It's going to be maybe our generation's Great Depression. I know my dad always used to talk about some of the things they went through during that time. Obviously, we're so much wealthier than we were back in those days, but it is something we're all going to remember. We're going to remember what we did this particular spring and maybe summer, where we stayed home and we did things that we don't normally do. So it's if there is something positive out of it, I think that's really interesting. We've spent a lot of time in our family with my kids who are both one in graduate school and one graduating this year from college, and don't get to see them as much. And we've been able to spend a lot more time together, obviously, because there's not as much to do out there.
That's great. James, you have anything that you've taken away?
I've got
we probably all share the same sentiment.
Yeah, no, ironically, I've got to know more neighbors through this whole process. There's more people on the street than ever before. So that's been fun. And I think
they have their circle drawn around them.
Yeah, James is maintaining his 6 feet.
Six feet distance.
That's right.
And, but just the ingenuity in terms of the speed that we transform from at the office to at home. I mean, I've got couple of my kids doing dance classes on the Zoom. I'm like, what is going on here? It's just amazing to see.
For those of you who don't know, James has 4 girls under what age, James?
Under 10. Yeah,
Under
it's
10.
Good times at my house.
God bless you.
All right. Well, guys, thank you so much. This has been fantastic. It's been great. I've had fun. I love laughing with you guys. We hope everybody's gotten a benefit out of it. We have Thursday coming up, we're going to kind of get the inside scoop on how the banks are having to react to this, particularly as it relates to the Paycheck Protection Program that they've all had to scramble to do. I think the biggest takeaway for me is when we have these periods of crisis like this, there are extreme stressors that come into play at many levels. We need to breathe, take a step back, and we really need to do our best to try to look at the other side of the table, because we just, our perceptions are our realities. Whether that's reality or not, it's our realities. And we just have to walk away with a better appreciation of what everybody is facing on their end. Because one of the biggest reasons why I wanted to bring this forum together is not only to educate, but to empathize. And I think if there's anything that I've gotten out of this, it's definitely been to be a whole lot more empathetic, because sometimes I just haven't realized what somebody else is up against. So I appreciate your time today. Everybody, thank you so much. Have a great rest of the afternoon, and we look forward to seeing you on Thursday. Thanks, guys.
Thanks, Mark.
Thank you, Mark.